Hey everyone, welcome back to the channel. For the first time since 2020, we have the perfect storm of events, all taking place at the exact same time, causing some of the largest single-day losses since COVID, and we all know how that turned out. It's happening fast, and it's affecting everyone. So today we're diving into exactly what's going on. Let's talk about exactly what's happening, why the stock market has fallen so much, what this means for you, and what history tells us is most likely to happen next. If you find this information helpful, please hit that like button and subscribe to the channel. It really helps me to keep bringing you the latest updates. Now, let's get started. The recent stock market crash has been driven by a confluence of factors, each amplifying the effects of the other. Firstly, inflation rates have surged to levels not seen in decades, prompting central banks to raise interest rates aggressively. This has increased borrowing costs, putting pressure on both consumers and businesses. Secondly, geopolitical tensions, especially the ongoing conflict between Russia and Ukraine, have added a layer of uncertainty, disrupting global supply chains and spiking energy prices. Lastly, investor sentiment has been shaken by fears of a looming recession, leading to widespread sell-offs. All of this begins because of the Japanese yen unwinding. Look, even though this sounds like a complicated term, it's really easy to understand if we break it down. On the surface, global economies are extremely interconnected. What happens in the UK has the potential to impact the United States. China's decisions have a large effect on the demand of the US. And when one country is economically stronger than another, money tends to flow out and into something else, which is what's happening here. Even though our money has lost a significant amount of its purchasing power over the last 50 years, it's still the reserve currency in the world. That means there's consistent demand for US treasuries. Think of it like this. Every country has their own unique currency, interest rate, and inflation rate, which is constantly measured by what it gets you in US dollars. This means there can be arbitrage opportunities where you borrow in one currency at a low interest rate, put that in another currency at a higher interest rate, and then you profit the difference, which is what's happening with Japan. For more than 30 years, the Japanese yen has been on a downtrend. In fact, their financial system is so bad, with decades of deflation, an aging population, and weak demand, that interest rates remain near historic lows just to incentivize spending, borrowing, and trade. They could get away with that because, until recently, inflation for them has been non-existent. What will happen next? Now, in most cases, this isn't that big of a deal and global interest rates tend to balance each other out. But recently, something changed. Because the United States battled with record-high inflation from 2022 to 2023, they were forced to raise interest rates at the fastest pace ever in history. All of a sudden, the United States was paying a very competitive interest rate that was completely risk-free. This presented a very unique opportunity where traders could borrow the yen at a low interest rate, put that in US dollars and treasuries at a high interest rate, and then profit the difference. On top of that, historically, the yen has also gone down in value relative to US dollars, which means that by the time you actually have to pay off your loan, it'll require fewer US dollars to be able to pay it back. So you could also make a profit on top of that by paying back less than you borrowed. As an example of this in really simple terms, imagine you borrowed 1.3 million yen at 0.5% interest, which would get you $10,000. You could then take that $10,000 and buy a 12-month treasury that earns 5.5%. If everything stays the exact same after 12 months, you now have $10,500, which is equivalent to 1,371,000 yen. You pay back the 1.3 million plus interest, and now you have roughly $500 worth of profit, all while investing in something that's backed by the full faith of the US government. However, like I mentioned earlier, there is one factor that could either be the biggest blessing or curse when it comes to this, and that would be currency exchange. In terms of how severe this is, Japan saw their single biggest day loss since Black Monday of 1987. Basically, just imagine if our stock market was down 13% in a day versus the 3%. Well, that's what Japan just dealt with. Of course, some people might wonder why Japan would raise interest rates like this if it's going to be such a big issue. The answer to that is inflation. Remember, when the Japanese yen declines in value, it requires more of that currency to be able to buy goods and services from other countries. So they were forced to raise interest rates to prevent their currency from falling even further. All of this accumulated into a rather large, abrupt sell-off. The thing causes a lot more fear, which causes an even bigger sell-off, which causes a lot more fear, and the cycle repeats itself. What does this mean for investors? Short term, it can lead to losses and volatility in your portfolio. For those nearing retirement or with significant investments in stocks, it can be especially stressful. However, it's essential to remember that stock market crashes, while painful, are often part of the market cycle. Historically, markets have recovered over time, and crashes can present buying opportunities for those with a long-term perspective. So, with all this in mind, are we doomed? Not quite. As you can see, after enough time, there are plenty of occurrences where the market eventually begins to recover, some producing substantial returns, but you have to be patient. As of now, in the big picture, we're simply back to the same place the S&P 500 was 3 months ago in May. We're down less than 10% from the peak, which is extremely common. On average, a 10% market correction happens about every 16 months, and in the last 20 years, a 10% drop has happened 11 times. Even though these circumstances are unique, stock market drops are not. This doesn't mean the stock market can't fall even further, but it's too early to tell if this is just a short-term hiccup or a signal of something much deeper. It could get a lot worse, or it might be a short-term panic that normalizes within a few days. That's why, no matter what happens, it's always important to be prepared for the worst. Don't panic. Sell the psychology that makes you want to sell when the market drops is the same that makes you buy back in at the peak. Over the last 20 years, a $10,000 investment in the S&P 500 would have grown to $64,000 if left untouched. Missing the best 30 days, typically after the worst days, evaporates your profits. Lastly, always maintain a steady income to continue buying in or avoid selling investments. Thanks for watching. If you found this breakdown of the recent stock market crash helpful, please like and subscribe to Money College for more insights into the financial world. Share your thoughts or questions in the comments below. I'd love to hear your perspective. See you in the next video.